Welcome back to Navigate Your Wealth. I'm your host, Kristin Oakley, here with both Karen and Sam from Compass Financial, and they are unwrapping a lot more details about how life insurance, maybe it's not just what you think for the death benefit, but there are so many other benefits while you're alive, including tax efficiency, then transfer of wealth. You know, one of the things I've heard you say is that cash value life insurance is like a Roth IRA on steroids.
Yep.
I want you to share with our viewers why that is.
Yeah.
So we say that it's like a Roth IRA on steroids because it's like a Roth IRA, but so much better. Listen, if you can qualify for cash value life insurance, and the reason that we say if you can qualify is because life insurance, since it's a death benefit, is based on health. So if you can qualify for cash value life insurance, we're going to talk about the ways that this outperforms a Roth IRA. So when we're looking at them side by side, you put the money in after tax. Same.
Right.
During the growth, or during when the money is in there, it grows tax deferred. Same.
Okay.
When you take the money out, it's 100% tax free.
Right.
Same. That is where the similarities end. When you look at a cash value life insurance policy, there's a few elements that we would be remiss not to bring up. First is a self-completion clause. That death benefit that we were talking about, if you've put in $7,000 into your Roth and $7,000 into your cash value life insurance, and you die the next day, with your Roth, all you have is the $7,000. With your cash value life insurance, you have the death benefit. You have such a greater benefit because of that self-completion clause.
But we don't want you to die.
No,
Right.
Our plan, as we said in the very beginning of this episode, are living benefits. So let's talk about those.
Yes.
The living benefits is the access. With a Roth IRA, you are limited to when you can access the cash.
Right.
For the first 5 years of the money that you put in, we have limitations. When you're talking about the money you can pull out, you have to be a certain age. Once you've taken the money out, you can never put it back. With cash value life insurance, you can put the money in, you can take the money out, you can put the money back. So that revolving door really becomes your liquidity. As we mentioned, our Power of Three strategy in previous episodes, that cash value life insurance and the cash that is there becomes a greater strength. Also, we talk about the bank of you for our clients, right? We want to make sure that you have access to liquid assets. And with the cash value, you've not only got the death benefit, but you've got that cash that continues to grow.
Sam, I want to jump in for just a moment because you brought up the bank of you, and I think it's so important for our listeners to understand. As Samantha said, with the Roth IRA, you have that 5-year limitation. You cannot touch your premium or your contributions until at least 5 years has passed. And then you can't touch the earnings until you're 59 and a half. With the life insurance, once that cash value is in that account, it is yours. You can do whatever you want with it. I started life insurance policies for Samantha and her brother when they were 9 and 11 years old. When we moved to Charleston, South Carolina, Samantha feels very accomplished because she got her brother to move the year later.
Nice.
So she got a whole family back to the East Coast.
Right.
But when Scott got here, he needed a car. He had $40,000 in his cash value life insurance policy. He pulled $10,000 out, bought a car, and we set him up on a repayment back to the life insurance policy of $200 a month. So he didn't buy a car from the car dealership and give them the benefit.
Right.
He borrowed the money from himself and paid himself back. Now, one of the things you talked about, the $7,000 IRA, we had a client that challenged us on this. You have to understand, if you put $7,000 in a Roth and $7,000 in life insurance, at the end of 20 or 30 years, we ran these numbers for this client. There is no question the Roth is going to have a greater value, even at the exact same rate of return.
Okay.
Because the life insurance has cost.
Right.
We understand that.
Yeah.
But here's what most people don't understand, and here's what we had to prove to this client. When we now take the money out, your Roth IRA, you're taking that money out. It is no longer in the account. So the amount that you can withdraw, whether you do a systematic withdrawal or you buy a guaranteed income annuity or whatever you do with it, it's finite. Life insurance is a different animal. You have something called indirect recognition or variable loans that you can do with life insurance. When Scott took that $10,000 out of his policy, that $10,000 was actually still in his policy. There's something called arbitrage. If the interest rate to take that $10,000 out at the time was 3.5%, and his policy earned, I'm going to make the math easy, 9.5%, he actually still made 6% on the money that wasn't even in there. He was driving it. So here's why when you do the Roth versus the life insurance, and the client was blown away, the amount of income that they could take over their lifetime out of the life insurance, even though the initial balance started lower, was significantly greater than what they could take out of the Roth IRA.
Well, and just for math's sake, you know, with Scotty's situation, if something had happened to him and the death benefit needed to be paid, it would be the death benefit
minus
less the $10,000 that he had taken out.
Or whatever he hadn't paid back yet.
Or whatever he hadn't paid back yet. So, you know, there's a little bit of a catch to it, but it really is a tool that we recognize. And for you at home, if you have not explored this tool, we want to help you learn more. Pick up the phone today and schedule your retirement roadmap. We want to do a tax burden analysis to understand if these tax-efficient tools that we are using can help you live your dream retirement.
Karen, Sam, thank you so much. Thank you for joining us. We'll see you next time on Navigate Your Wealth.